Welcome, guys. I want to go over the PM session, the Silver Bullet hour from 2 to 3 p.m. Eastern Time. First, I want to show you my rules of engagement here. This is how I trade. So my rules, I usually trade the 2022 mentorship model. I need a higher time frame liquidity to be taken. Then I need to see a swing high or swing low broken to show the market structure shift. And then I'm looking for a displacement that formed a fair value gap, or I'm looking left and looking at other PD array entries. Maybe it's a breaker block, a mitigation block, or an order block. And then my entry parameters, I want to risk 1 for 2, so risk to reward ratio is 1 to 2. And I need a minimum of 5 handles. Okay, ideally you want more, but minimum 5 handles. Stop placement goes below the first candle of the fair value gap or above or below the breaker block, mitigation block, or order block. And I can move my stop to break even and take a partial once price reaches 60% of target. Okay, those are the rules, so I'm going to leave those on the screen. So 1:30 starts afternoon trading. And so it's highlighted light gray. The dark gray is the 2 to 3 p.m. Silver Bullet hour. So when it starts at 1:30, I look left. The high is here. It's taken out. The low is here, has not been cleared. As price trades down, it does take that lunchtime low. So a higher time frame liquidity has just been taken out, going towards the 2 p.m. Silver Bullet hour. So once we clear that, we also clear this right here. So that right there is another short-term low cleared. So we've taken liquidity. So number 1 is done. Okay, so then we're looking for a market structure shift. Where do we get that? We get that right there. Price comes up, comes down, comes back down, and takes it out right here. Okay, so as this is coming up, it also took out right here. So if you made your candles lines, you could see that there's right here would be a short-term high taken. So technically right here you're looking for any kind of pullback. Okay, so as it's coming up here and it's doing this displacement, I'm looking left, I'm looking what's going on, where my PD array is, what's going on. And so what I see immediately that pops out to me is an order block right there without having any wicks right here. That's a high probability order block with a volume imbalance right there. Let me show the high volume imbalance just so in case there's people that can't see it. Right there is volume imbalance. What else do we see? Do we see a fair value gap? Yes, there's one right here in this displacement move. So swing high broken? It is broken. This is a displacement move. Yes, there's displacement right here. Short-term high is taken out right here, so we would have missed these things. However, if you would have used, just used this right here as your market structure shift, as I showed you before, you could have, so it's just right there, as I showed you in the lines, you could have taken a thing right there. But I'm going to show you why I wouldn't have taken that. That to me is I don't like it when it's this. I need to see a higher shift like this, so it's a little bit more clear. But if I would have waited till this high was taken out, we missed our entry of the fair value gap, the order block, the volume imbalance. But here is the mitigation block. Okay, mitigation block, bullish mitigation block. It is a swing high that does not take out a swing low. Okay, so if this would have been a breaker block, it would have been the swing high, would have came down and taken out that swing low, and then traded up and back to it would have been a breaker block. But here it's a mitigation block because here's your swing low, swing high, comes down, fails to take out this swing high, and then trades back up and down into it. Now, I'm going to zoom in here because I want you to show you this candle here, how this worked. Okay, let me show you. At this point right here, I'm actually going to replay this to show you something right here. Okay, go back here. Right here, this is a potential mitigation block. Okay, all price has to do is come back down into it. Okay, then it is left. It's closed above it, so it is left the mitigation block now, and the potential mitigation block. And when it comes back into it, It could be one candle, it could be the very next candle, it could be 20 candles, it could be 100 candles, it could be 50 candles, whatever. Whenever it comes back down, that makes this a mitigation block. There's your entry. The very next candle, it wicks, comes down and wicks back out. So it wicks into it. That right there is your entry. Okay, so let me zoom out. Let me go back here like this and play how this plays out. See how it plays out right here. Right there. So it may have taken you out here. It probably wouldn't have with the spread. So it may have been here. There's your entry right there. So that's how you could have taken these trades. Now you could have, like I said, you could have taken this market structure shift and came back down into a fair value gap. And right here would have been your trade. Right here, you would have taken, here's 3.5. You would have had to taken it to this one. So there's 9. ICT teaches us 10. Shoot for 10. You would have easily gotten it right there. So that would have been, it had to use this small short-term high cleared. You could have gotten in here order block, which would have been down here. And what price would have been right above it. There's your order block entry. Again, now you're right here. All these trades would have been, and it would have worked out fine for you. Okay. I like to see along how it plays out a little bit more, but they never see how nothing came past into closed below the middle of the order block. It's a very high powerful PD array, especially with no wicks there. It's a high probable order block. That's your silver bullet trade right there. So that is how I see the 2 p.m. silver bullet trade for May 18th.